Welcome to Health and Wealth Simplified, where we help make sense out of financial and health topics. Since we're filming this in November, we thought it'd be a good idea to speak about the money you must take out of your retirement accounts when you reach a certain age. The specific term for this is required minimum distribution, or RMD. Steve.
No, you're right, Bob. And the reason we're talking about this now is because you don't want to forget. If you or anybody you know has ever forgotten to take out their distribution for the year, you realize that the penalties can be significant.
Like what?
Like 50% federal. That's the penalty on top of your normal tax rate. So you want to make sure that you don't forget to take it out. Yeah.
I got 50% penalty and I'm in the 30% tax rate or something like that. It could be 80%.
Yeah.
Whoa.
So, you know, your income for that year is close to butkus.
Yeah.
Yeah. So that's how it works. Thank you very much.
So, wait a minute. I don't want to get hit with a 50% penalty because I got busy. Is there a way that I can have it automatically sent to me so nothing bad happens?
There's lots of ways to get it taken up and have it set up so you don't have to worry about that. So, you know, that's an easy fix. You just don't want to forget about it.
Would you remind me if I was close
listen,
to it?
we get all kinds of reminders. I get reminders. My clients get reminders. You can have a secondary person be reminded. So,
okay.
Yeah, I mean, and you know, since the Simple Act was amended last December of 22, the date that you have to start taking them out, the age has been changed a little bit for younger retirees. But that's something we can get into later. But for right now, I'm going to assume that we're talking to people that are already taking their distributions out. So, you know, how it works basically is when you have a retirement account like an IRA or 401k, you know, company-sponsored plan, at a certain point in time, you have to start taking money out of that account when you reach a certain age. Typically, it's 72 for younger people. Younger retirees, this age is going to go up to 74. But the government wants to make sure you start taking that money out for your retirement so they can tax it.
So the only certain things in life are death and taxes.
Correct.
It's with the IRS, it's pay me now, pay me later.
But pay me a whole lot if you forget. Yeah.
Okay.
Yeah.
Right. So the amount you take out basically is calculated on the balance of your retirement plan the prior year. So the money you have to take out for 2023 is calculated on your account balance on December 31st of 2022. And that's your IRA, that's your 401k, that's your 457 plan. They add them all together, and that's the amount that your distribution is calculated on. And I mean, the calculations are, you can find them on the web from the IRS, and it kind of goes up a little bit every year. Every year you're older, the more money you have to take out.
So, say you have like $100,000.
Right.
And that's in your 401k and your IRA, maybe you have a third thing.
Yes.
So do you have to take it out a little bit out of each one, or can you like pull it out of one thing that you don't like as much? Or?
Yes. You can do it either way.
Oh.
Just as long as they get the whole amount out, doesn't matter what account or how many accounts it comes out of, just as long as you got the whole amount
So
out.
the required minimum, is it like a set dollar amount or is it a percentage?
It's a percentage.
Okay.
So, and that, like I said, the percentage increases every year you're older. So every year you're going to take a higher percentage of the account
So the
out.
older you are, the poorer you want your account to be?
No, you don't, because we have this little thing happening a lot more now than we did a few years ago called inflation. So it's not a horrible thing. But it can affect your taxes. So, you know, you want to make sure that you plan for how you're taking your distributions out.
Yeah.
There's actually a way where you can avoid tax on that distribution altogether called a qualified charitable distribution. That's a conversation for a different day, but there are ways you can deal with it.
Wow.
And then, yeah, I mean, once you take the money out, the government got their tax. They don't care what you do with it. You put it in your savings account, take a cruise, give it to your kids or your grandkids, you know, whatever, give it to a charity.
I think you should put some in your savings. What?
So how would that affect then my Medicare payments?
This is what I'm thinking. If you take some of this money out, you know it's going to affect your IRS amount. You definitely should put some in savings because it can actually raise your Medicare Part B and your Medicare Part D premiums. Because everyone has a base amount and it goes up every year. It miraculously went down one year, and my whole life I'm like, what? But it's not probably going to ever do that again. So every year it goes up a little bit. And if you make more than the average financial bear, then guess what? You're going to be paying more on your Medicare Part D and your Medicare Part B. So
Okay.
you need to be prepared for it. Plus, that's also going to affect your Social Security. So if you even take Social Security early, that's also going to affect how much your taxes are, because you can be taxed up to 85% of your Social Security income.
So planning for this is kind of important.
It's
Yes.
super important.
All right. So make a plan. talk to Steve, talk to Alina, let them help you out. Until next time.
Plan responsibly.
Bye.
All right.